Hello everyone, welcome to Apex Capital, and in this video we will understand what is enterprise value, also known as EV, and why do analysts and fund managers prefer to use enterprise value multiples like EV to sales or EV to EBITDA in order to value their companies. So enterprise value is nothing but a measure of the company's total value, just like market cap. Now, as we all know, to calculate market cap, we just take the current market price per share and multiply it with the total number of outstanding equity shares. That gives us the market cap. Now, enterprise value is derived from the market cap. The formula is enterprise value is equal to market cap plus the total debt on the company minus cash holdings of the company. So, let's understand with an example. So here is a company, Vari Energies Limited. This is a listed company in the National Stock Exchange, and the current market price per share is about 2676 rupees. So I'll take this number and multiply it with the total number of equity shares, which is 28.8 crores. So this gives us 77,000 crores. So this is the market cap of Vari Energies Limited. Now, in order to calculate enterprise value, the formula is market cap plus debt minus cash. So let's take the market cap and add the company's debt to it. So go to the balance sheet and as you can see, company has long-term borrowings, short-term borrowings, lease liabilities. So add all these and the total number of debt comes out to be 2941 crores. So take this total debt and add it to the market cap. Now we need to subtract the cash holdings of the company. So go to assets and here you will find the cash equivalents, which is 7784 crores. So this is the cash which we need to subtract. So putting all the values, the enterprise value comes out to be 72,200 crores. So as you can see, for Vari Energy's market cap is about 77,000 crores and enterprise value is around 72,000 crores. So that's how you calculate market cap as and enterprise value. Now, always remember that when taking debt, you have to add all the short term, that is current borrowings, and non current, that is long term borrowings, as well as any lease liabilities which the company has. Similarly, for cash holdings, include all the cash holdings as well as the cash equivalents, which includes bank balances and even short term investments into mutual funds, liquid funds, etc., whatever the company has done. So, EV is equal to market cap plus debt minus cash. Now, since EV is derived from the market cap, there are two possibilities. EV can either be higher or lesser than the market cap of a company. Of course, it will depend on the net cash position of the company, where net cash is equal to cash minus debt, right? So, if the company is net cash positive, enterprise value will be less than market cap. If the company is net cash negative, enterprise value will be more than market cap. Now, it's common sense really. Basically, if the net cash positive means company has more cash than it has debt. So in this formula, if you see, if the cash is more than debt, EV will be lesser than market cap. On the other hand, if the company is net cash negative, which means company has less cash holdings than the debt on balance sheet, then EV will be more than market cap, right? So the funda essentially is, if cash on balance sheet is more than debt on balance sheet, enterprise value will be less than market cap. On the other hand, if cash on balance sheet is less than debt on balance sheet, then enterprise value will be more than market cap. Of course, we all love cash and nobody likes to have debt. So in general, enterprise value less than market cap is considered a good sign. Of course, it's not always the best indicator, but in general, enterprise value less than market cap is a sign of healthy balance sheet. All right, so now that we know how to calculate enterprise value, next question is, why is it a better metric than market cap? It's because enterprise value conveys much more information than market cap about the true valuation of the business. Market cap is what you pay when you want to buy a business or a company. Now, when you buy a business, you are not only buying the core operations, but you also are buying the debt of the company as well as the cash holdings of the company on the balance sheet. Now, debt is like a hidden cost because ultimately at some point in future, the owner of the company himself has to pay the debt. Similarly, the cash holdings of the company are like a hidden discount because all the cash of the company ultimately belongs to the owner of the company. Now, market cap doesn't account for both of these components. But enterprise value in the formula itself includes market cap along with the debt as well as the cash holdings of the company, thereby taking into account both this hidden cost as well as this hidden discount. Thus, enterprise value gives a much more complete view regarding the valuation of the company compared to the market cap. Now, similar to market cap based ratios with like price to sales ratio or price to earnings ratio, we can also have enterprise value based ratios. These are known as enterprise multiples and they can be EV to sales ratio, EV to EBITDA ratio. Out of these, the most commonly used and the most important ratio is EV to EBITDA ratio. Now, just like price to earnings ratio has market price per unit share, that is the market price of a single share as the numerator, and the after tax PAT earnings per share as the denominator. In case of EV to EBITDA ratio, enterprise value is the numerator, and EBITDA, which is earnings before interest, taxes, depreciation, and amortization, as the denominator. Just like lower the PE, cheaper is the company. Similarly, lower the EV EBITDA, cheaper is the company. Now, some people tend to use price to earnings ratio to compare different businesses in the same sector. There's no problem in that, but in general, EV to EBITDA is a much better ratio to compare different companies in the same sector. Why? Because EBITDA stands for earnings before interest, taxes, depreciation, and amortization. EBITDA is also known as operating profit of the company. Now, EBITDA is earnings before interest, which means it excludes the effect of debt of the company. EBITDA is also earnings before taxes, which means it excludes the effect of the local tax rate of the country in which the company operates. Again, EBITDA is also earnings before depreciation and amortization, which means EBITDA excludes the effect of the capital structure of the company. For example, in certain asset heavy businesses, there's a large number of assets of the company in the on the balance sheet. This leads to a very high depreciation expense every year on the P&L statement as well. Now, this leads to low earnings of the company. Now, if you just take a look at the price to earnings ratio for such asset heavy businesses, you will find that the price to earnings ratio is very high because of the low earnings, which again are due to depreciation expense. But and you might conclude that the business is overvalued, although that is not the case, since depreciation expense is a non-cash expense. It's there is no actual cash outflow from the company because depreciation expense is taken only for accounting purposes, right? So, for such asset-heavy businesses, EV to EBITDA gives us a better gauge at the profitability of the core operations of the company as compared to the after-tax earnings or the price to earnings ratio. All right, now let's try to understand this with the help of a few examples. So these are two companies, Bharat Forge Limited and Bharat Dynamics Limited. So both of these are defense manufacturers and defense related companies in the and listed companies in the Indian stock market, right? So now, defense industry is typically considered a asset heavy business. So, both these companies, if you notice, have a very high price to earnings ratio. For example, Bharat Forge has a PE ratio of 65.6, while Bharat Dynamics has a PE ratio of 86.3. So, if you just take a look at the PE ratio, you will conclude that both of these companies are almost equally overvalued, right? But that is not the case. Since if you also take a look at their EV to EBITDA ratios, you will notice that Bharat Forge has an EV to EBITDA ratio of 26.5, while Bharat Dynamics has an EV to EBITDA ratio of 54.5. Thus, Bharat Dynamics is more than double as expensive compared to Bharat Forge Limited, right? If we are talking about the EV to EBITDA ratios. So that's why EV to EBITDA ratios is more helpful while we are comparing asset heavy businesses. Because if you just take a look at PE ratios, then both of these companies are more or less equally expensive. But only when we take a look at their EV to EBITDA ratios, we figure that BDL is more than double as expensive as Bharat Forge Limited. All right, so that completes our discussion on enterprise value and EV to EBITDA ratio. That's all for today's video. Thanks for watching and see you in the next one.